Thank you for joining me today for today's presentation. We're going to be covering Chapter 8 of my book, Financial Independence, Getting to Point X. Today's topic is going to be planning for retirement. This is actually version 2 of 2. If you didn't listen to version 1 of 2, I would encourage you to listen to both so you can get a full understanding of this chapter, Planning for Retirement. As I said, it's one of my most important chapters in the book. Because it's by definition how to get to point X, and that is what retirement planning is all about. Please take a second to read the famous quote up on the screen, and then we'll jump into the presentation. So today we're going to be talking about Roth IRA contributions. And before we do that, I want to just simply define the difference between a traditional IRA and a Roth IRA. So with a traditional IRA, which most people are familiar with, you contribute money to a retirement plan. The money you contribute is typically tax deductible, and then that money goes into a deferred account. And over the years, you're going to continue to contribute money to that, and then during your retirement years, when you pull the money out, it's all going to be subject to tax. So you're getting the advantage of upfront tax savings, you get the advantage of tax deferral, and you get the big advantage of earning money, not just on your money, but the tax dollars you didn't have to give to the government. Terrific way to save for retirement. The other retirement account is called a Roth IRA. A little different, but depending on your facts and circumstances, that might be the better choice for you. So when you put money into a Roth IRA, you do not get any upfront tax savings. So you don't get that same big tax deduction you would get with a traditional IRA. But the big difference is the money you put into that account will continue to grow over the years, depending on how you have it invested, but every penny of it will forever be tax-free. So now that we defined the difference between traditional IRAs and Roth IRAs, I want to go through a number of Roth IRA contribution strategies with you. So up on the screen, let's talk about this. If you qualify, you should make a contribution directly to a Roth IRA account each year, assuming that's the better choice for you. Although you will not receive that upfront tax savings, these contributions and all withdrawals, including all your earnings, will be forever tax-free during your retirement years. In order to qualify for a Roth IRA, your adjusted gross income has to be within these levels. So if you're single or head of household, if your income is under $129,000, you can make a direct contribution to a Roth IRA. If your income is between $129,000 and $144,000, you could do a partial contribution. If you're making more than $144,000, you do not qualify to do a direct Roth IRA contribution. And just under that is the threshold for married couples filing jointly. If you are not eligible to make a tax-deductible traditional IRA contribution, you may still want to make a non-deductible traditional IRA contribution each year to supplement your retirement savings. So let's assume for a minute that your income level is too high and you cannot do a traditional tax-deductible IRA contribution and get a tax deduction for it, and you don't qualify to do a direct Roth contribution. You're still permitted to do a non-deductible traditional IRA contribution. So assuming you and your spouse could each make a $6,000 contribution to an IRA, and by the way, if you're 50 or older, there's a catch-up provision, so you could do $7,000 per year. This will avoid the 3.8% Medicare tax on personal income investment, which is an added benefit to the tax deferral. So generally, if you're in a high tax bracket, you'll end up paying an additional 3.8% Medicare tax on your investment income. If you have money in a Roth IRA, any income you generate from that Roth IRA will not only be free of federal and state tax, but you'll also avoid the 3.8% Medicare tax. So let's go through Roth contribution strategies. We may want to convert your traditional IRA, primarily the non-deductible contributions only, into a Roth IRA each year, so all of the earnings will grow tax deferred. So what this is called is a backdoor Roth conversion. So it is a little tricky on how to do this. So before you go out and do it, please speak to your tax advisor, your financial advisor. The tax form that you need to report this on is Form 8606. Now, it's very important. You must tell your accountant when you prepare your tax return, I made a non-deductible traditional IRA contribution. Please make sure you record that in Form 8606 so that you have a permanent record with the IRS that you made non-deductible contributions. If you don't do that, then ultimately those non-deductible contributions, when you pull them out, you're going to end up paying tax on that. And that would be a disaster because you got no tax break up front, and now you're going to pay tax on that same money twice. So check with your accountant. If you've been making non-deductible contributions in the past, please check with your tax preparer. Find out if they've been filing that form and they have the right number there. If not, ask them to fix it as soon as possible. So with that said, let's continue on with this strategy. Let's read the slide here. If you have other traditional IRA accounts that came from tax-deductible contributions and earnings, this could complicate doing a backdoor Roth conversion, since your accounts will be taxed proportionately based on your cost basis. I know that sounds very confusing, so I'm going to try to explain it with this example. So let's assume for a minute you have $60,000 in total traditional IRAs. $54,000 of that IRA balance came from tax-deductible contributions and earnings over the years. Then this year you contributed $6,000 to a non-deductible IRA. So $6,000 into $60,000 is 10%. So what this means is that 90% of your conversion would be subject to tax. So if you converted the full $60,000 this year from a traditional IRA to a Roth IRA, $54,000, the part that was done in pre-tax dollars that you got tax-deductible contributions for, the full amount would be taxable. I've seen people make this big mistake, not understanding how the Roth conversions work, not knowing what their basis is, and then come tax time, they're hit with a tremendous tax bill that they weren't expecting. So you need to be very careful with this. Don't attempt this on your own, because chances are something will go wrong. So what do we do here? Well, another strategy that many people aren't aware of is as follows. Many 401k plans allow you to roll over your traditional IRAs into them. The reason you want to consider doing that is if you have a certain amount of traditional IRAs, again, if you have millions of dollars of traditional IRAs, you may not want to take this approach. But if you have 100 or a few hundred thousand, this approach may make economic sense. So what we end up doing is, from the same example, you're going to take that $54,000 that you had in tax-deductible contributions to your traditional IRA, roll that into your 401k plan at work. What that will do is it'll leave you just with $6,000 in traditional IRAs at that point. Now when you go to do your conversion to a Roth from your non-deductible, you'll pay no tax on that Roth conversion. I agree, you're only converting $6,000, but not only will it help you do that for that year, but now you'll be set up for every year going forward that you're still employed and making non-deductible contributions. You'll still be able to make a $6,000 Roth conversion, backdoor Roth conversion contribution. And again, once you hit 50, that number will jump up to $7,000 per year. If you have a spouse, that number could be $14,000 per year if you're both 50 and older. So over time, using these backdoor Roth conversion strategies can make a big difference. Now, another thing that you want to be aware of is that traditional IRAs, your 401ks, your company retirement plan, those at a certain age, you're going to be required to take required minimum distributions. Whether you need the money or not, you're going to be required to take it out because the government eventually wants to tax you on that money. So depending on what your age is and when you were born, Your required minimum distribution may start at age 70 or it may start as late as age 72. And there's talk right now they may even extend that. But here's the problem. With that distribution from your retirement accounts, you're now going to be forced to pay taxes on your retirement savings. For those people that are in lower tax brackets, that could also make part of your Social Security taxable during your retirement years. This is another very big distinction between traditional IRAs and Roth IRAs, because with a Roth IRA, there is no required minimum distribution. So this means you won't be forced to pull money out of your retirement account. And then eventually, if you never need that Roth money, you can just leave it there, continue to make it earn income on a tax-free basis. And then when you pass on, you can leave that Roth account to your children. Your children at that point will continue to have the tax-free benefit of it. But based on pretty recent tax laws, they're going to have a 10-year window after you pass on to pull that money out. If it's in a Roth, I would encourage your children at that point to keep the money in the Roth till the end of that 10-year period. And then at that point, they could pull all that money out on a completely income tax-free basis. What a terrific inheritance you could leave to your children, some tax-free money, something you definitely want to consider.